Avoid doubling, tripling, or even quadrupling of your Medicare premiums. That's what we're going to talk about here today at the Heritage Wealth Planning YouTube channel, going into chapter 5 of the book, The Tax Bomb in your retirement accounts and how the Roth IRA can help you avoid it. And this is where, again, we started to talk about Social Security taxes, we talked about income tax, all that. We're going to really dive deep into an area that many people overlook, especially when they're married filing jointly and they don't recognize the tax bomb that they're leaving to their spouse. And this is the URL. I'll put a link to the show notes where you can get this book for free as a PDF. You can always go to heritagewealthplanning.com. Should be a pop-up right there. They can just put your email, your first name, and your state, and then you'll get the PDF file you can download for free. It doesn't cost anything. You can even go to Kindle Unlimited. It's free there too. But I'll put the URL for this book in there too, that you can go in and you can see all the stuff I've written about it, and just put your email address, your first name, and your state, and I'll get you on the list, and you can and you'll get this book for free as well. So if you like what we do here, don't forget to subscribe down below. You'll see that little red tag or button that says subscribe, and then hit the bell to be notified for future content. We're doing a couple videos a day now, just really getting it revved up. I'm loving the positive. Seems like momentum I'm getting on the channel, so I'm doing a lot. It just gets me fired up. In fact, today I woke up at like 3:30 thinking about videos I got to do. I know it's crazy, but it's something I've been wanting to do for over 20 years in business. Be able to tell my story and what you need to be thinking about. And when you're working for the big firm, they don't let you do that. So it's good to be able to do that now, working on my own. So let's dive right into this. I tell you, this is interesting. This I can't remember how I figured this out. I forgot, but if you like to learn and you're willing to listen to people's point of view, even if they initially differ from you, you can learn a lot from other people. And I tell you, I've learned an amazing amount of people, in particular on the life insurance side. I can't lie. I don't sell any life insurance. I'm not a huge life insurance proponent necessarily. But some of these guys just knew better financial planning than the investment side. In my industry, and this might bore you to death, but you got the investment guys and ladies, and you got the insurance guys and ladies. The insurance guys and ladies are always trying to sell you life insurance policies. There's no getting around that. You know for a fact that you're going to get pitched a life insurance policy, rightly or wrongly. The investment guys are always trying to sell you investments, how their investments are better or whatever. It's just, and at the end of the day, both those guys have their own, I guess, if you're a hammer, everything's a nail. But what I found was, as I started being more and more in the business in the mid to late 2000s, the first part of this century, and then as I started reading on my own and studying for my master's degree and all that, the folks on the life insurance side just had, bar none, more knowledge of overall financial planning than the folks on the investment side. It wasn't close. The folks on the investment side were trained to sell you investments. The folks on the insurance side were trained to sell you financial plans, which could lead to a life insurance or disability insurance sale. And by the way, they happen to get in investment management as well, with variable annuities and whatnot. And, be it as it may, but they were trained to do full-fledged financial planning in order to sell you something, where the investment guys are just trained to say, hey, you can make more money if you invest with me. And frankly, there's no evidence of that whatsoever on the investment side. There's absolutely, the evidence goes the other way. The insurance side, I think, is too bad because they have a lot of chops to bring to the table, but this training that they have, where they have to hit you 7 times before you finally buy, that's why the insurance guys, just wash out of the business, because no one wants to be told 7 times, but just no one wants to be told that. So if they just focus solely on the financial planning side and happen to offer a life insurance that when it hit the bill or fit the bill, I think they'd be a lot better off. But, who's going to listen to me? So anyway, long story short. So let's talk about this. Again, chapter 5 from the book, the easy way to avoid doubling, even tripling, even quadrupling your premiums. But I couldn't write that there because it made the chapter too big. So, I'm just going to go right into it. Chapter 5. With a Roth IRA, there are no required minimum distributions. I cannot stress how important this is. This means you can allow your Roth to grow for as long as you want without ever having to take money out. A traditional IRA, 401k, 403b, TSP all require at the age of 70.5 that you start taking minimum distributions out. Now, there is a caveat there. If you have an employer-sponsored plan, a 401k, TSP, or 403b, you don't have to start taking out at 7.5 as long as you're still employed by that firm. But if you have multiple 401ks and you have a 401k from company X, 401k from company Y, 401k from company Z, and you're still only working at company Z, you have to take RMDs from 401k Y and from 401k X, as well as any IRAs. That's the drawback about 401ks. You have to take RMDs from each 401k, 403b separately, and whereas an IRA can conglomerate them, or aggregate them, I should say, into one account. It's not the purpose of this chapter, but another reason to consolidate things because of the menace of you having to take our 401k distributions from each 401k you have out there. And again, real quick, 401k is all encompassing with 403bs and TSBs. All right, well, what if you don't need the money? It doesn't matter. The IRS needs it more than you, and they want their taxes, and they want it today. It's like J.G. Wentworth, it's my money and I want it now. That's what the IRS is saying. So let's talk about this. So let's say you're 70 years old and you have $100,000 in your 401k or IRA, whatever. Your RMD will be $3,650. And the reason you do is you look at this table right here, and this is straight from IRS publication 590. And you say, I'm 70, I have 100,000. So I take my trusty calculator, I take $100,000 and divide by that, 27.4, and I get this number right here, 3650 roughly. That's the amount of money that has to be taken out by 31 December of that year. Okay, if you don't, you will pay a 50% tax on this amount right here, the amount that you neglected to take out from your RMD. Just on a side note too, another side note, take out the first year. So many people say, well, I don't have to take that when I'm 7.5. I can wait till I'm the following year. Yes, you can do that. Don't do it, because then you're doubling up. You're not only going to have this RMD, you're going to have this one as well, which is divided by 26.5. So you're going to have two RMDs in 1 year, which means you're going to pay more income tax. Don't do that. Just take it out the year you're supposed to. Don't push it off till April 1st of the following year, because you're going to have two required distributions that year, which is going to affect your income tax for that year big time. All right. Now I can hear some saying, Josh, paying $3,700 isn't that big deal. I'm in the 12% tax bracket, so it's only going to be about $400 in taxes. So, well, that's correct. Absolutely. The first couple years, RMDs are not a big deal. It's 3.6% the first year, 3.8% the next year, 3.99% the following year. But as you get older, in fact, here we talk about it, at 82, in fact, what happens is the first couple of years of your RMDs, you're going to actually, if you have any kind of investments that are somewhat growth oriented, you're going to put more money in your IRA from growth than you're pulling out. So you start with $100,000, you're pulling out $3,700, you're just growing by $6,000. So you're netting another $3,300. So by the next year, you don't have $100,000, you get $103,000 because you had more growth in your account than the RMD that was taken out. I've seen that happen a million times a Sunday. So now let's fast forward to 82, and we go up to our trusty old calculator here. That's your divisor, 18.7. All right. Now we still have $100,000 in there because the market just essentially flattened off. We said we got $3,700 in the first year, $3,900 in the fourth year, blah, 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 blah. And the market gave us that money from growth. And so we haven't had any principal essentially reduction because we started with 100,000. We've been pulling money out, and the market grew enough, and now right back to where we were. And that happens all the time. So now your RMD is about $6,000. All right, $6,000 at an 82-year-old, and is going to continue growing simply because the older you get, the smaller the divisor is for your RMD. So now what was before a 36.4% distribution is now a 5.84% distribution, because as you get older, the percentage of distribution gets larger and larger and larger. And if your account is growing as well, and again, there's a good chance that'll happen, the actual dollar amount that comes out of your RMD gets higher and higher and higher too. All right, so now let's talk about Medicare premiums, because this is what gets overlooked. Medicare premiums are means tested, which means the higher your income, the more your premiums will be. And we are not talking small potatoes here either, my friends. A single taxpayer with a modified adjusted gross income of less than $85,000, they will pay a Medicare Part B premium of $134 a month plus $34 a month in Part D premiums. All right, so that's $168 a month in Part B and Part D. We're not even talking about Medigap. We're not talking, which is Medicare Supplemental policies. We're not even talking about Medicare Advantage. We're talking about Part D and Part B premiums. Now you add those other things, that's going to add more premiums that you have to pay, but we're not talking about that in this case. We're just talking about Part B and Part D. Now, what happens once that taxpayer goes above $107,000? Well, her monthly premiums are no longer $134. They're now 168 total when you factor in Part D and Part B. 134 in Part B, 134 in Part D. These premiums now are $335. They double. So a single taxpayer, modified adjusted gross income of $85,000 or less, pays $168 in Part B and Part D premiums. The minute that modified adjusted gross income goes up by $22,000, their premiums double to $335 a month. So let's figure out what modified adjusted gross incomes are. Well, first of all, we got to understand AGI is everything before your deductions, either itemized or your standard deductions. It's line 37 of your 1040. You got to flip over to line 44 of your 1040. So I can't remember. It's 44, I think, which will give you your taxable income. But line 37 is your gross income. Now, modified adjusted gross income is even worse because it takes any tax exempt interest that you have as well. So you take all your income, not included Roth IRAs because they are excluded from the calculation. You add your tax exempt interest, and that gives you your modified adjusted gross income, which is how the IRS figures out if you got to pay tax on your Social Security or how much your Medicare Part B and Part D premiums will be. The maximum premium for Medicare Part B and D is $504.80 per beneficiary. Now, it's not likely you're going to get there, but that's where you get your quadrupling because remember, 134 is a Part A, a Part B premium for a modified adjusted gross income of less than $85,000, but starts creeping up there. And look, we're just talking $22,000 more of income before taxes are included or tax deductions are included, and you're doubling your premiums. Well, you could literally have a $504 big time premium increase if you have a big IRA distribution or just any kind of income. A big income hit could really, really hit you on your head for Medicare Part B and Part D. All right, so higher RMDs equal higher taxable income, which equals higher Medicare premiums. And that's just the facts. Higher required minimum distributions equals higher taxable income, which equals much higher Medicare. So let's just go back to this for a second. Let's say you're 86 years old. I'm just throwing this for an example. Your spouse has passed on. You got $250,000 in an IRA. You divide that by 14.1, and now you have $17,730 of required minimum distributions. You add that to all your other income. You have a pension. You take half your Social Security as part of your modified adjusted gross income. You have tax exempt interest. You have all these other sources of income. Maybe you've been working. I don't know. Maybe you're writing books and you're selling them. I don't know. But you have $250,000. You're 86 years old. You divide it by 14.1, and that is your RMD, required minimum distribution, which is going to the bottom line of your taxable, your gross income, of your modified adjusted gross income. So now you have $17,730 of RMDs. The minute you breach that $107,000, you are paying double for your Medicare premium. So we just take $107,000, subtract $17,000. So if you have $90,000 of other income other than Roth IRA, you are going to double your Medicare premiums. Now, if you're married, filing jointly, it's not a big deal because you got to have $170,000 before that were to happen, and that's going to be tough. That's a lot of money. But if you receive an IRA from a deceased spouse, and you still have those required minimum distributions, which you will, and you still have to take the required minimum distributions, which you do, and you get older and have to take more required minimum distributions, which you will, you can see how quickly those RMD is going to affect you big time when it comes to your Medicare premiums. Bad news. What avoids all that? A Roth. A Roth. Take advantage of the Roth while you're married, filing jointly, and your income brackets are low. All right, that's all we're going to share with you on this one. I think that one gets overlooked on Medicare Part B and Part D. As always, if you like what we do here, subscribe down below with a button that says subscribe. Click on the bell to be notified for future content because we're doing tons of stuff here at Heritage Wealth Planning. Don't forget to go to the blog. If you go to the blog, you'll see the pop-up over here, and I put the URL, which is a MailChimp. It's free for me to produce this, which is why it's pretty good. And I'll give you a little story about why retirement assets are an IRS's dream, and they're not your dream for sure, because that's where the revenue is. But you can get the book for free on either of those places. If you go to Amazon.com, you type in my last name, Josh Scanlon, or my first and last name, obviously Josh Scanlon. You can get Kindle Unlimited for free. The book itself is $5.99, the hard copy, and it's $4.49 on Kindle if you don't have a Kindle Unlimited subscription. See you next time on the Heritage Wealth Planning YouTube channel. Thanks, guys.